Howdy, Jacob here. Today we're going to do a more in-depth analysis on Federated Investors, ticker symbol FHI, in the capital markets industry. The first time we did this analysis, it looked like a screaming deal based on my initial financial forecasts of free cash flow and earnings. But today we're going to go into more depth based on my review of the company's most recent quarterly reports and 10Q and 10K. And so I'm going to first go over just a general overview of the financials. Then I'm going to get into the specific points that I pulled from those reports. Just recall everything I say is my opinion. Do what you want with it. And, let me know if you agree, disagree, as I, go through my final results. So it is in the capital markets industry, 2.9 billion enterprise value, 3.1 billion market cap. They are a publicly owned investment manager. The firm produces its services to individuals, including high net worth individuals, banking or thrift institutions, investment companies, pension and profit sharing plans, etc. And so the company is founded in 1955, based out of Pittsburgh, Pennsylvania. Their revenue growth over the last 10 years does look pretty impressive. 859 million in 2014 to 1.6 billion in 2023. When it comes to capital market industry, the capital market industry companies, when the stock market does really well, and the products that they sell do really well, it's pretty easy for them to do well because it's kind of an effect on itself and really increasing the, I guess, not negativity or positivity, but basically the more the stock market does well, the more people are going to invest because they don't want to miss out all this other stuff. And so, I was actually pretty surprised that that the growth wasn't more. I mean, this isn't growth greater than the market or anything, but still pretty impressive growth. Revenue doubling, almost doubling over the last 10 years, with a pretty impressive gross margin in the mid 60s. Operating margin also impressive in the mid 20s, but it is down quite a bit from 10 years ago. They do pay a dividend. It's pretty flat over the last 10 years. Good return on invested capital. With that said, they do spend a majority of their capital allocation on share repurchase and dividends, and their balance sheet shows a good amount of cash on hand, over $500 million, with less than $500 million in long-term and short-term debt, and great production of free cash flow, huge cash from operations with almost no capex, pretty common for this capital market industry. So let's go over some of the notes that I took from reading the quarterly reports, 10K. So they have 6.2 million shares outstanding in their share repurchase program as of 2024 Q3, representing over 7% of the current outstanding shares. So they do have the capability of buying back shares up to 7% based on their current market cap. Not bad. Okay. Their year-end 20, or not market cap, but the amount of shares they have right now, 7%. Year-end 2023 money market assets made up roughly 72% of all assets under management. So majority of the funds that their investors hold are actually their money market accounts, with only 13% to fixed income, 12% to equity, 3% private market, and less than 1% multi-asset. So to me, that kind of makes more sense to why their revenue growth wasn't as big. If they were more invested in equity, then I would have presumed that more people would have just piled on. But with majority of their funds being in money market accounts, and then money market accounts really not giving you that high of yields pre-COVID. So you're looking at, a good chunk of the last 10 years was negligible, almost nothing for money market accounts. So less surprising, I guess, from my perspective. But they're an investment management business where majority of revenue comes from investment advisory fees. They run over 180 funds and market these funds out to banks, institutions, brokers, and other customers. So it sounds to me, I did a review. I haven't posted this, but personally did a review on T. Rowe Price, and it's a pretty similar business to that. I looked up some of their expense ratios, and they're about 0.5%. So I was comparing that to some of the ones in my 401k, and I do obviously look at expense ratio. I think that's incredibly important. I think if you have a long history of outperforming your benchmark, then it can be possibly fine to pay up for it. But in most cases, I think just following the index fund is probably just going to do as well. And so I really look for less than 0.1% expense ratios when I look at funds for, my retirement account, and then, funds that I assist with other people. And so to me, these are kind of expensive, not as expensive as they used to be, of course, but still 0.5%. Probably nothing that I would invest in unless it was a true long history of outperformance. Expense ratios for their top 10, speaking of expense ratios, their top 10 performing mutual funds over the last 10 years were between 0.46 and 1.01, averaging 0.8%. So pretty substantial. If you ask me, this is kind of all over the place. This is their large, mid, small, international funds. And they're a little bit more expensive than I would like. So their CEO and president is also 74 years old, with most other high positions on the board and upper management filled by individuals over 60. So this isn't a bad thing. And I think, especially now, people are working quite a bit longer. They're more able to, both physically and mentally, do some more challenging things that maybe they weren't doing in the past. And so I don't think it's egregiously old, but for me, it's definitely, so I don't think this is much of a negative as it is, a positive when you see a younger person. When you see someone who's a founder, especially who's in their 40s or 50s as their CEO, that makes me very confident that they're really going to push this business to be the best they can because it's their baby and they're still young and thriving. Here, 74, I'm not going to say is old, but I'm not going to say it's young either. So although it's, maybe a little bit of negative to me, um, it's just something I wanted to call out. 350 million of long-term debt due no later than 2032. They pay interest semi-annually, and on an annual basis, it's roughly 3.3%. And they have more cash on hand than their long-term debt with no short-term debt. So again, balance sheet perspective, no concern. Capital allocation of free cash flow for the last 3 years was 80% to share repurchases, 39% to dividend, 4% to acquisitions, and 35% increase in debt. So we can see that this is obviously over 100% with share repurchases, dividend, and acquisition. That's because they issued 35% of debt. So my capital allocation for the next 7 years will be forecasting 100% capital allocation. And that's going to be assuming the dividend stays roughly the same because, again, historically, we haven't seen them increase it too much over the last 10 years. And then I'm just going to be bumping a little bit of share purchases on top of that since that's their main two forms of capital allocation. Roughly 11% of their total revenue in 2022 and 2023 came from one intermediary. So, again, not a bad thing. It's New York Bank of Mellon, I believe. And so pretty big bank. See no concern with that. Just wanted to call it out there. Slightly individualized with a little bit of their income, but 11% for one client, and that being, pretty consistent client, not terribly concerned about. So really, I think when I put in my new assumptions, I think that there's a lot of competition when it comes to the capital market industry, and people are understanding that just following index funds is, just as good, if not better than 90% of mutual funds. And so why pay those extra fees when really the outperformance historically isn't even there? So I think there's going to be a little bit of competition, which is going to both dampen their revenue growth as well as their margins from my initial assumptions. And then their PE, price to free cash flow, is based on their historical PE and price to free cash flow being much lower than the market. So you want to balance out, what you think it's going to be with what it's done historically. It'd be the same if I were looking at a house and I was seeing the price was way lower in that area than another area. There's something about that area that I just may not understand. And so looking at the historical P and price to free cash flow is important, I believe. And so when I put in my new assumptions, we're saying that it still looks pretty close to a buy, needing to fall 29%, but definitely not a screaming deal like my initial assumptions said it was. I hope you enjoy this video and have a great rest of your day. Thank you.